Silver is trading near $62.47 today. Just a few days ago, it was sitting above $71, and now we are approaching one of the most important moments this silver market has faced in months. In less than a week, nearly 197 million ounces worth of paper silver contracts are set to confront a COMEX system that currently holds only about 86 million ounces of registered deliverable silver. This isn't speculation or a dramatic prediction. It's a scheduled event already marked on the CME calendar, and the countdown is underway. Most investors are focused on the sharp decline we've seen over the past several sessions. Financial media outlets continue to repeat the same explanation, claiming silver is simply falling because geopolitical tensions have eased and safe haven demand is fading. That sounds reasonable on the surface, but it leaves out the most important part of the story. To understand what is really happening, we need to step back and look at the sequence of events that brought us here. When conflict between the United States and Iran intensified earlier this year, silver reacted in a way that confused many investors. Instead of immediately surging, the metal experienced significant pressure. The reason was not a lack of demand. The reason was the Federal Reserve. As oil prices climbed during the conflict, inflation expectations rose. Higher inflation increased the possibility of additional rate hikes. As rate hike expectations strengthened, the US dollar gained momentum. Silver, which sits at the intersection of monetary demand and industrial demand, was caught directly in the middle of that storm. The paper market responded aggressively, selling first and asking questions later. Fast forward to mid-June. A ceasefire framework emerged, and suddenly, the market began pricing in a different future. Silver briefly rallied back above $70 as traders adjusted to the changing environment. But once the peace agreement was officially confirmed, a new narrative took over. Investors were told that precious metals no longer had a reason to rise. Safe haven demand was supposedly gone, the risk premium was removed, and silver began a rapid decline. In just 5 trading sessions, the metal lost more than 12% of its value. But here's what many analysts are missing. The ceasefire did not suddenly eliminate the structural forces supporting silver. It simply changed one piece of the puzzle. What disappeared was the geopolitical inflation premium tied to energy markets. Oil prices began to retreat. As crude moved lower, expectations for future inflation also started to soften. That created hope that the Federal Reserve might become less aggressive than investors previously feared. This is where the story becomes interesting. The paper market immediately reacted to that shift. Physical silver did not. While traders focused on headlines and short-term price action, the underlying supply picture remained largely unchanged. Industrial users did not cancel orders. Solar manufacturers did not stop consuming silver. Electric vehicle producers did not suddenly reduce their demand. Data centers, semiconductor companies, and power infrastructure projects continued operating exactly as before. Meanwhile, the COMEX delivery system remains under pressure. The registered category, the silver immediately available for delivery, stands at roughly 86.2 million ounces. Yet open contracts represent claims on vastly larger amounts of metal. Even though total eligible inventories appear much higher, a significant portion of that silver is already allocated and not freely available to satisfy delivery requests. That distinction matters far more than most investors realize. When you compare the registered inventory to the potential paper obligations approaching first notice day, you begin to understand why so many experienced silver watchers are paying close attention to the next several sessions. This isn't just about a falling silver price. It's about what happens when a heavily leveraged paper market meets the reality of physical supply. And over the next few days, every major indicator worth watching will start pointing us toward the answer. Now let's focus on the number that matters most over the next few trading days. The registered silver inventory on COMEX sits near 86.2 million ounces. That is the metal currently available to satisfy delivery obligations. On paper, total eligible inventories appear much larger, but that figure can be misleading. A large portion of eligible silver is already owned, allocated, or committed elsewhere. Not every ounce listed as eligible is waiting to be delivered to futures holders. When those adjustments are considered, the buffer protecting the market becomes much smaller than many investors assume. At the same time, open interest in the July contract remains elevated. Tens of thousands of contracts are still outstanding, representing hundreds of millions of ounces of silver on paper. The critical question now is simple. How many of those participants intend to roll forward, and how many intend to stand for delivery? That answer will begin revealing itself day by day. Between now and the final days before first notice day, the most important figure to watch is not silver's spot price. It is the pace at which open interest declines. If contracts disappear rapidly, the pressure on the delivery system eases. If open interest remains stubbornly high, the market receives a very different signal. This is why experienced traders are watching contract positioning more closely than headlines. The next few sessions also bring several economic reports that could influence expectations for inflation and Federal Reserve policy. Housing data, energy inventories, and other macroeconomic releases will affect the US dollar. And as silver investors know, the dollar remains one of the strongest short-term drivers of precious metals pricing. If crude oil continues moving lower after the ceasefire and inflation expectations continue easing, the market could begin pricing a less aggressive Fed. That would likely weaken the dollar and create a more supportive environment for silver. But while traders debate interest rates, something else is happening beneath the surface. Throughout 2026, physical delivery activity has remained surprisingly strong. March saw substantial delivery demand. May also recorded significant amounts of silver standing for delivery. Even smaller delivery months attracted meaningful participation from buyers willing to take physical metal rather than simply trade paper contracts. That pattern matters because it shows that demand for actual silver has not disappeared. In other words, this is not a market where everyone is content to settle financially and move on. A growing number of participants have consistently demonstrated interest in obtaining physical ounces. That brings us back to the vault. Think of the next several days as a stress test. If registered inventories remain stable and delivery requests are absorbed without difficulty, the market moves forward with little disruption. If inventories begin falling toward lower thresholds, attention will increase quickly. And if inventories drop sharply enough to push coverage ratios into historically tight territory, traders around the world will be watching every vault update closely. The reason is simple. Physical markets operate differently from paper markets. Paper sentiment can change overnight. Headlines can create panic one day and optimism the next, but physical supply conditions evolve much more slowly. When inventories tighten, they do not instantly rebuild. When industrial demand grows, it cannot be turned off with a single news announcement. That is why many long-term silver investors are paying closer attention to vault data than daily price swings. The coming sessions will reveal whether recent selling was merely a reaction to changing macro expectations or whether something deeper is happening beneath the surface. Every open contract, every inventory movement, and every delivery notice will help tell that story. And as we move closer to June 30th, the gap between paper claims and available deliverable metal remains the single most important issue in the entire silver market. Now let's step away from the day-to-day volatility and look at the bigger picture, because this is where many investors make costly mistakes. Imagine someone who accumulated silver when prices were below $30 and held through the incredible rally that followed. That investor watched silver surge throughout 2025, reach new records in early 2026, endure the volatility surrounding the Iran conflict, and now sees prices back near $62. The question they're asking today is the same question thousands of silver investors are asking around the world. Has the investment thesis changed, or has the market simply repriced short-term expectations? The best way to answer that question is by examining the fundamentals. First, the global silver market remains in deficit. The latest industry data continues to show that demand exceeds supply, marking another consecutive year of shortages. That reality did not disappear because a ceasefire was signed. A geopolitical headline does not suddenly create millions of additional ounces of silver. Second, industrial demand remains remarkably strong. Silver is no longer driven solely by investment demand. It is a critical material used in modern technology. Electric vehicles, advanced electronics, power grid upgrades, semiconductor manufacturing, and artificial intelligence infrastructure all require silver. While some sectors have improved efficiency and reduced usage per unit, overall industrial consumption continues expanding. None of those industries paused their growth plans because tensions in the Middle East eased. Third, mine supply remains constrained. Bringing new silver production online is not a quick process. Developing new mining projects often takes years, and much of the world's silver is produced as a byproduct of other metals. That means supply cannot rapidly increase simply because demand rises. These factors are structural. They develop over years, not days. Now compare those long-term fundamentals with the factor currently weighing on silver prices: Federal Reserve expectations. Unlike mine supply or industrial demand, monetary policy expectations can change very quickly. A single inflation report, employment release, or Fed statement can alter market sentiment almost overnight. That is exactly why silver often experiences sharp moves in both directions. The same rate hike expectations contributing to today's weakness could become tomorrow's bullish catalyst if economic data begins moving in a different direction. Looking ahead, investors will be closely watching inflation reports, PCE data, upcoming Federal Reserve meetings, and future CPI releases. Every one of these events feeds into the same chain reaction. Lower inflation expectations reduce the probability of tighter monetary policy. Softer policy expectations tend to weaken the dollar. A weaker dollar has historically provided support for precious metals, particularly silver. That is why many long-term investors are focusing less on the recent sell-off and more on the conditions developing underneath it. At current levels, silver is trading far below where many institutional forecasts place year-end expectations. Major research groups continue projecting substantially higher prices than where the market stands today. Those forecasts are not guarantees, but they demonstrate that many professional analysts still see significant upside potential despite recent weakness. The key takeaway is simple. The recent decline was driven primarily by changing expectations surrounding interest rates and geopolitical risk. The core drivers behind silver's long-term story, industrial demand, supply constraints, physical market tightness, and ongoing deficits, remain largely intact. That is why the next several days are so important. June 30th is approaching rapidly. The delivery process will provide valuable insight into the health of the physical market. After that, attention shifts back to inflation data, Federal Reserve policy, and the broader economic outlook. Watch the chain of events, not just the daily price. A lower inflation path can influence Fed expectations. Fed expectations influence the dollar. The dollar influences precious metals. Understanding that sequence is far more important than reacting to every headline. For now, silver sits near $62 while the market prepares for one of the most closely watched delivery periods of the year. The vault numbers, the delivery data, and the upcoming economic reports will determine what happens next. Make sure you're subscribed to Ag John Silver Update so you don't miss the daily vault updates and delivery analysis as we move toward First Notice Day. Let me know in the comments. What do you think the coverage ratio will look like once the dust settles after June 30th? I'd love to hear your forecast. This content is provided for educational and informational purposes only and should not be considered financial, investment, legal, tax, or accounting advice. Always conduct your own research and verify all information before making any investment decisions.